Warren Buffett says never depend on a single income. Make investments to create a second source. In this section, we will first cover various cautions and considerations before investing, explain each different investment platform out there, and most importantly, give you the tools to decide what type of investor you are going to be. As you continue to build your wealth and cash flow, eventually you can become an accredited investor, which allows you to get much higher returns on investments because it's basically the big leagues for investing. To be an accredited investor, you need to have $1 million net worth or make $200,000 personally or $300,000 jointly with your spouse per year. Even if this is a little far down the road, it's good to have it in the back of your mind for the future. A common misconception is that if we make more money, we end up paying way more because we're put in a higher tax bracket. This is true, however, it's charged marginally, not retroactively. The tax bracket is a bell curve, so even though your top bracket might be 35%, every dollar in the 10% bracket is only getting charged at 10%. The next dollars you earn will be charged at 35%, however, all the money you have already earned stays the same. Also, by changing how you earn your income, you can change the rate that you are charged for taxes. For the most part, businesses and investment incomes are taxed less than normal income. One great concept you need to remember for investing is the Rule of 72. Albert Einstein says that compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. The Rule of 72 says that whatever interest rate you have, divide 72 by that interest rate, and that'll tell you about how long it'll take to double. For instance, if you have a 12% return, 72 divided by 12 is 6, so it'll take about 6 years for your money to double. You can try this on your calculator on your phone for any interest rate. Go ahead and multiply 1,000 by 1.08, an 8% gain, and count how many times you have to multiply it in order for it to double. Notice how each year the growth increases because the interest from the previous year is also growing. If you did it correctly, then it should have taken 9 times to double. Part of the reason that this is so important is the earlier you start, the better. The longer you wait to invest, the more you will have to put in just to recover. Now that you know the Rule of 72, also realize that statistics and numbers can be manipulated. Sometimes you hear mutual fund or investment brokers brag about average rate of return, so let's jump into the real numbers instead of using these averages. Let's use simple numbers for example. First year you have $1,000 and over that year it increases by 100%. Wow, that's amazing. You are now at $2,000. Second year, your $2,000 suffers a 50% loss. Ouch, you're back down to $1,000. Third year, your $1,000 sees a massive spike of 100% growth. You're back to $2,000. Fourth year, your $2,000 suffers another 50% loss, so you're back to $1,000. Some fund managers brag because 100% minus 50 plus 100 minus 50, well, that's 100% over 4 years, so it looks like 25% growth per year, even though in reality your wealth didn't grow at all. In fact, it's even worse than that. That doesn't factor in the fund manager's commissions draining your potential profit away, because even if the market goes down, he still gets paid. This also doesn't factor in inflation, so each year your dollar is worth less and less. Money times interest rate times time is an antiquated model if the market doesn't perform correctly. Who do you know that's older and wanting to retire, but can't because their investment portfolio is underperforming and forcing them to wait? If you currently have a financial advisor or think it's better for someone else to manage your money for you, ask yourself these questions. What is this person's track history? Does my advisor guarantee anything that will happen in the future? And if so, do you think any person has the ability to see into the future? Is this person a fiduciary and legally bound to do what's in my best interest? Or are they trying to sell products that give themselves the biggest commission? What fees am I paying? And how much does that impact my compounding interest? Is this person able to do real due diligence and charge a commission at the same time? Not for all, but for some it's big conflict of interest. Just remember, no one will be a wiser steward of your resources than you. Who cares more about preserving your wealth than you do? Relinquishing your control is the highest risk possible. You have zero control of the outcome, good or bad.